I'm Cynthia Rowland, and this is episode 123 of EO Radio Show. In today's episode, I welcome back Jennifer Nelson, a senior wealth manager with BNY Mellon. Jennifer and I recorded this episode on Friday, May 9th, 2025, and this episode posts on Monday, May 19th. The investment world looks quite a bit different today than it did in May of 2024, when Jennifer and I recorded a general investment policy planning episode. And it's even a bit different than just 10 days ago, with the public securities markets continuing to swing up and down, but not quite as dramatically as in early April. When we recorded 10 days ago, Jennifer remarked on the state of the market volatility at the time. While this past week has been a bit calmer, we've also seen new surprises. A major new tax bill came out of Congress with some potentially dramatic tax implications for foundation endowments, another new factor for investment committees to take into account. And more international talks and agreements developed with the on-again, off-again tariffs and perhaps stabilizing international agreements on the horizon. Nevertheless, Jennifer's remarks provide insights for investment committees and board members during these turbulent times. I hope you'll find some useful tips in today's episode. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. I'm so happy today to be joined by Jennifer Nelson. She's a senior wealth manager with BNY Mellon, and she's been there for the past 9 years. She spent 8 years before that at Cambridge Associates, which is a leading investment consultant for endowments and foundations. At BNY Mellon, Jennifer focuses on investment management and complex planning for private foundations, endowments, and high net worth families. Well, thanks for joining me, Jennifer.
I really enjoyed our conversation last time, and I'm looking forward to talking about the markets.
Great. So just to kind of set the stage, last year when we talked about these topics, Jennifer, I started with an overview of UPMIFA. That's the uniform law that governs directors in their management of charitable assets and the duties of the board when managing and investing funds held by charities for investment. UPMIFA generally directs that the board consider 9 factors in the context of its investment management. And I'll just refresh the listeners on what those factors are. Number 1, the charitable purposes of the institution and the purposes of the investment fund. Number 2, general economic conditions. 3, the possible effect of inflation or deflation. 4, the expected tax consequences, if any, of the investment decisions or strategies. A fifth factor to consider here is the role that each investment or course of action plays within the overall investment portfolio for the fund. Number 6 is the expected total return from the income and appreciation of investments. Number 7, other resources of the institution. Number 8, the needs of the institution and the fund to make distributions and to preserve capital. Sometimes those are at odds. And finally, the 9th point to consider is an asset's special relation or special value, if any, to the charitable purposes of the institution. Today, the factors that really jump out at me as especially pertinent are the general economic conditions and the possible effects of inflation or deflation. Jennifer, you must be getting a lot of questions from your clients about these topics these days.
Yes, I am. I think it's been an especially volatile year. And on top of that, that volatility has played into the news that everyone's digesting. So even if you're not following markets on a daily basis, you're very well aware that there's a lot of economic uncertainty. So it is very much the top question that I get every time I speak to clients, both with institutional, with investment committees, as well as the personal families that I'm working with. I do think it's important to put 2025 so far into context because it actually is not as dramatic as it feels. It feels like we should be down 20 to 30% with the way that the news and the volatility has played out. But as of the end of last week through today, it's probably a little bit more because the last couple of days have been down, but S&P is actually down just a little above 4%. With positive returns for most emerging markets and international indices. Tech is down a bit more, about 7 or 8%, probably 9% after today. It looks like we're down another percent today. And April was actually not that big of a sell-off. It was a huge sell-off for a while, and then we had a rally in the latter half of the month. Earnings, which is sort of the major driver of a lot of this, is actually up double digits year over year, higher than expected. So that's all the good news, but we don't want to be overly rosy about the volatility that we have been through, because we were in bear market territory. We were down 20% at one point, looking at an actual correction. And there are some risks, of course, in the marketplace.
I think back, I'm not an investment professional, but I've watched these things for clients over the past some years. And I remember the dot-com bust. I remember the 2007 financial crisis. And obviously I remember the COVID shot, just 5 years ago, we were all like, what's going on? In ways I think, well, this is the same. Things change and then markets adjust. And then I think, well, no, this is different because it just feels different. When investment professionals watch these cycles, I guess there must be a cadence to it or an understanding. Something shifts, there's reactions, and then what happens? So just, I'm trying to put it in context. How bad is this compared to the others? Is it really all that novel, or is it just more of the same? It's just a different flavor of a market volatility?
Yeah. So I think this year is just another flavor, as you put it, of a market volatility. But that being said, it is worth talking through the downside risk. Our base case scenario is not a recession this year, but that doesn't mean there aren't some changes into the realities of what we face economically and market conditions, specifically within the U.S., that are a risk factor that institutions can invest around and position around and just be aware of, because there are some risks in the short term with the tariff deals are not as announced. We don't have a lot of deals in place yet. There is some good news this week of potentially these get announced, but that is very much a moving target that, as I'm sure everyone is aware, changes on a daily basis. So that is, of course, a risk. And then the other one that has actually kind of arisen over the past week is some of the uncertainty on stimulus. If you're going to give a tax hike in the form of tariffs, which is basically what this is, you have to have an offsetting fiscal stimulus. And that would be the tax bill, not just extending what was already in place, the previous one that was set to expire this year, but also some additional cuts or some additional benefits through, extra depreciation or tax cuts, something on the corporate side. So that is still very much in flux. There's a lot of disagreement within the Republican Party on that. So the research partner that we work with, their base case scenario is now pushed back to potentially not an announcement or a deal in place until July. So that uncertainty is going to cause some skittishness within the markets. And that's kind of the near term. But I think institutions, and what I've been talking to clients about, is how to position for some of the long-term risk. And that is more about the long-term inflationary pressures, and then also some of the concern on slower growth and an eventual recession, because there are some concerning data points. And a lot of that is around consumer confidence and business confidence, and how much does that impact spending? Because consumer spending is such a huge driver of our GDP. And then business confidence directly impacts hiring and what is referred to as CapEx. That's really just their long-term spending plans of companies. Anytime there's heightened uncertainty, which is a perfect way to put what this year is, that freezes. And we've seen a lot of hiring freezes. We've seen a lot of companies tamp down on expenditure just with that level of uncertainty. The other big risk is on the inflationary side. It's tied into two major things. So the first one is, of course, the deficit and the long-term deficit, which is something we've been talking about for a long time. And then it's also thinking through the demographic shifts within the U.S., which ties into the deficit spending, because that's the mandatory spending programs that we have. And also just the demographic shifts with the change in immigration policy. And then there's also foreign ownership of U.S. assets. And this is really important in what we've seen play out in bond markets this year, which is the idea, if we don't have foreign purchasing of treasury bills, that causes long-term yields to go up. And the reason that is potentially harmful to the U.S. economy is because that ties in so much to borrowing costs. And borrowing costs are important. How much do corporations have to pay when they issue debt in order to fund their company spending? How much do consumers have to pay when they just get a mortgage? So that very directly impacts spending. And we're just going to have higher rates, not just for corporations, but also for the U.S. government in order to attract investors if we're not the safe haven asset that everyone wants to hold. I don't think we're there yet. That's certainly been a big talk, but it's a concern and it's something worth positioning around. So it's definitely something that we're watching.
So as we think about positioning, to me, at my high level of thinking about what the board should be doing, does this mean they need to revise their investment policy? Or how deeply does this affect the basic structure, the infrastructure in place at the board level?
Yeah, that's a great question because obviously this ties into investment allocation, but it actually does. There are with inflationary pressures, there are 3 considerations to keep in mind as it relates to the investment policy. So the first is benchmarking. A lot of institutions, specifically endowments that I've seen, will use an inflation piece to their benchmark. I think long term, like if you're looking at over 10 years, that's not a bad hurdle because of course you want to make sure that your portfolio is keeping up with inflation as you're spending money on things that the endowment is meant for. But that being said, inflation is now a much more volatile factor. We're not in that pre-2022, we were in just this extremely long time of 1% to 2% inflation, sometimes a little lower, sometimes a little higher, but very stable. So that's a much easier benchmark to use. But if it's really volatile, it's probably not appropriate for year over year tracking. So thinking more about benchmarking, if you're using a discretionary asset manager or if you have an investment committee that's managing themselves, just making sure that you're benchmarking against the major indices that reflect the risk level of the underlying portfolio. Make sure you're taking enough risk to actually achieve any inflationary headwinds, because obviously sitting in bonds or cash long term will not do that. So that's a big one. The other piece of it is the cash policy. Now is a really good time to take a look at that because, as I said, most of the clients I work with, they're actually not even negative for the year. They're probably flat because we have a very big belief in diversification. So it's a good time to think about what is our cash policy? What are our needs for the next couple of years? If there is a recession, some people are already seeing a slowdown in planned giving. That's not universal at this point, but if we get into a recession, that will be the case. So make sure that there is some type of reserve in place and that you're taking advantage of the various rates available. That's come down quite a bit in the last year. You're not getting savings and CD rates like they used to be, but there are still high rates in short-term treasury bills. There are still good rates within money market funds. So a lot of clients that I work with, my recommendation is to set aside some kind of reserve account where you buy laddered treasury bills, like 1 month, 3 months, 6 months, 9 months, 12 months, depending on the spending timeline, and actually invest in those so that you have that cash available and you're not selling into a recessionary environment. So that's been a really big one. And then the last piece, this is a little more, this doesn't apply to everyone, but it is an important consideration, is to think about debt. So a few organizations I work with do hold some long-term debt from expenditures or major projects they were working on via an investment line of credit. That's a bit expensive. It's not as expensive as it used to be. And we do believe interest rates will come down this year, although probably in the latter half of the year based on the guidance that we've gotten from the Fed. But think about what that benchmark rate you want to look for that we feel like is a good rate. So let's say the investment line of credit gets down under 4% again, sometime in 2026. It might be a good time to lock in that rate if we're worried about long-term inflationary pressure. And most institutions have vehicles to do this. You can put a swap in place to lock in that investment credit line for 10 years. I have a lot of clients that did this in going back to like 2021 because it was historically low rates on their credit lines, and they were putting, for taxable clients, tax payments for some of the endowments or not endowments, but some of the foundations that we work with for their non-pledged assets. They would put a credit line in place and you can do a swap on that. So you lock in the shorter term rates for up to 10 years, which has been really beneficial as we got up over 7% on these credit lines. So think about when you would want to actually go in and do that again if we're going to face inflationary pressure and we actually end up having those rates go back higher if the Fed has to raise again in the face of inflation after the next recession.
Yeah. Oh, those are really good thoughts. What about non-traditional assets? Do we change our thinking? I guess the theme of our episode today is what should we change, if anything? Do we change our thinking? First of all, talk a little bit about what non-traditional assets are for listeners who didn't listen to the prior episode together. And then what's changed there? Is there a change in the thinking?
Yeah, absolutely. So non-traditional assets would be anything out of holding stocks and bonds, right? If that's kind of the core investment portfolio for liquid assets that endowments and foundations would hold, the non-traditional assets are anything outside of that. If you are not a qualified purchaser, so under that 25 million level of holding investable assets, then think about commodities or public real estate, things that could be an inflation hedge. Those are traditional inflation hedges. It might be good to incorporate some of that into the portfolio. There's also a lot of things you can do within currency, although a lot of that does tend to be in illiquid vehicles. And then there are also for qualified purchasers, there are, of course, hedge strategies, global macro funds, private equity and venture cap, private investments that you can make within commodities and real estate and currency hedging that can be beneficial to portfolios. This does get to be slightly more complex. And so when I work with investment committees, we will typically do this on a one-off basis. So what is the specific investment? What is the purpose? What is the fee structure? What is the due diligence that has been done on this investment manager? That is extremely important. This is a sector of investing that's not everyone does the same. It's really important to have good manager selection and make sure that the fees that you're paying are justified. So it's very much a discussion point, and it's usually done with investment committees. But these assets can provide enhanced returns, which can be beneficial if we have a lot of inflationary pressure, and also downside protection in a time where bonds are under pressure and there's volatility within bond markets. We've seen a little bit of that in Q1 this year and in April. I mean, honestly, fixed income markets were probably just as volatile in April as equity markets were. There was a lot of swings, especially in longer term yields, as there was uncertainty around foreign investment in the U.S. specifically. That's why we saw some of the longer term yields go up. And then the other piece of it is, of course, the private equity and venture capital. So you want to look at a fund by fund, a manager by manager strategy, and make sure you're well diversified there in multiple vintage years, multiple investments, so you're not taking on too much risk.
Yeah. And a lot of those things are very long lead time diligence, how they fit in. I mean, I want to talk a little bit about timing the market and trying to make quick moves and the advice about how disastrous that can be. I think this is standard advice, is to work with an investment professional, develop a plan, stick to it. Yes, you do in volatile times take a different look, because each time these things happen, there's the discussion that you've just been having. But rapid moves, can you talk a little bit about what you see when clients make rapid moves, either trying to, change the allocations based on what's happening in the market, or decide, well, maybe we should have private equity. Let's dive into that. How do you counsel the clients or the members of the committee that want to do something now, make a quick change to their policy or their investment strategies?
That's a great question. And it's a very frequent question. I have it not just on reallocating investments, but also, well, we should go to cash for safety when things are selling off. And the reminder I always give is there's a very famous study done within the investment space going back to the 1990s that looks at people that try to time the market, because you can't just time it once. You have to time it twice. You have to sell at the right time and buy back in at the right time. That's almost impossible to do. If I could do that, I would be opening my own shop and charging extremely high fees to invest.
Nobody can.
Exactly. Right. So the issue is that if you pull out at the wrong time and you miss the best recovery days in the market or the best recovery months in the market, your annualized performance is significantly below markets. So if you're trying to time the S&P, for example, and you miss like the 10 to 12 best months of the S&P over the years, then you end up underperforming by 6+% on an annual basis, not just over that time, but on an annual basis. That's a significant give up in return.
And I think the flip side of that is the institution that receives a sudden bequest or some large amount of money is distributed to them and they need to start investing it. And how do you think about, well, should we get it all? Markets are down. Let's put everything in today and see what happens. We've got our allocations versus the gradual investment. How do you keep people from taking their time in investing, in going into the market with a big amount of money?
Yeah, so I'm a big fan of dollar cost averaging to a certain degree, not over like a year, but over a few months, just being aware of volatility. But you can't just only think about, okay, I'm going to dollar cost average into the S&P because that's what's sold off, or to the NASDAQ because that's what's sold off the most this year. Make sure that as you dollar cost average, it's in line with the investment policy statement. Ideally, the investment policy statement is diversified. So you're not just holding the S&P 500. You're holding other types of markets. You're also holding fixed income. You're also holding commodities. And you're moving the cash into those markets as well, those types of assets as well, because you want to stay in line with investment policy. And thus also take a really strong look at the cash reserve. I mean, having an influx of cash when there's a really big time of volatility is actually great timing, right? Because you can invest some, but you can also shore up your cash reserve and make sure you're not being irresponsible with that holding. Because I do think it's important when thinking through a potential recession is to make sure that, hey, if we have a slowdown in gifts, in plan giving, in annuity gifts, whatever the organization tends to get the most of, that we actually have some reserves in place to combat that.
That's really good advice. So wrapping up, do you have any last words of wisdom, anything that we haven't covered yet that you'd want to put front and center in the mind of our investment committee members and board members who are maybe not investment professionals, but really want to do their best in these turbulent markets?
Yeah, I think my last words of wisdom that we touched upon a little bit, but I just really want to underline is the importance of diversification. And a lot of people say this and it because it is extremely good advice, but I just want to pull in a little market history of what's going on now and where we previously were pre-financial crisis to really underline that point. I think in the last 10 years, especially, a lot of clients that I've worked with have really focused on the S&P. That's their benchmark for all of their stocks. They want to make sure they're getting S&P returns. They're super overweight to US because that's where the growth is. And that's not wrong. That is where the growth has been. The US markets, US companies have added trillions of dollars more than European companies and some other Asian companies. It's significantly more growth. But if we go back pre-financial crisis, the assets that were considered the riskiest because they would offer the most return were international developed. Though there were many years where that had the most return. It was important to hold those because that's where you were going to get the performance. And while they have underperformed over the last decade, those have been the leading companies and the leading markets this year. And that has helped mitigate some of the downturn that my clients have held. It doesn't mean you want to have half your portfolio in Europe, but it is important to have multiple types of investments, multiple types of equities, so that you have that diversification in place when we have odd years like what we're having right now. Tactical allocation shifts around that is also important. So there are times to be overweight to the US, times to be underweight, times to be overweight to smaller companies versus larger companies. Those tactical shifts are important and they do add a lot of value to return over time. That's been pretty well proven. Getting asset allocation right is really important. That is the actual driver of return more than manager selection, but you still want to have diversification. You still want to hold all those assets even if they've been underperforming. And I think we're really seeing why that's important right now. And if we're worried about the U.S. keeping pace with some of the policy changes, then it's even more of a reason to hold some non-U.S. investments.
Well, this has been fantastic. Thank you so much for taking the time to talk to me about these topics today. And
Absolutely.
We'll hopefully come back when things are less turbulent and talk about some other investment topics.
Yeah, I've enjoyed the conversation as well.
Thank you.
Thanks, Cynthia.
So that's all for this episode. Be sure to check out the show notes for links to more resources. And a link to our episode last year will also be in the show notes. So for an overview of the basics of the topics we talked about today, you may want to navigate back to the EO Radio Show episode 82. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.